Hello, my friends. Today is August 19th. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about two things, but we're going to go a little bit more in depth. First, we have to talk about what's happening in China. China is one of the largest economies in the world, and there are some pretty concerning things that are happening there. And what's happening in China is likely going to reverberate globally and impact financial markets in the US. So we have to find out what's going on there. Secondly, we have to talk about the big news in markets this past week, and that is the US 10-year yield rising to 15-year highs. We've been talking about this for some time. We told you this was going to happen. And now we're going to talk about the drivers and what that means for markets going forward. Okay, starting with China. So the way that I look at this, at the end of the day, what's happening in China is that there was a tremendous property boom that is in the process of deflating. Now, this is something that we actually see happen over and over again in many countries and throughout history. Now, it happened in the US in 2006 and 2007. We had a huge boom in real estate. We had cab drivers, we had waitresses, we had hairstylists, everyone owning 3-4 properties and becoming really rich. And then, for seemingly no reason, suddenly the property prices began to decline, and then everyone went bust, all that money disappeared, and we were in a very deep recession. This happened in Japan in the 1980s. In Japan in the 1980s, there was a tremendous property boom, such that reports were the land beneath the Imperial Palace in Tokyo was actually worth more than the entire state of California. So Japanese were feeling rich. They were taking their money. They were coming out to the US, buying large prestige properties. And it seemed like they were taking over the world. And then suddenly, one day, the property market deflated and Japan was caught in a deflationary spiral for a few decades, actually. So, and of course, this also happened in Southeast Asia, where countries like Thailand also experienced huge booms and busts during the East Asian financial crises in the 1990s. So this is something that is totally normal, and many were expecting it. However, the timing is always very tricky. But it seems to be happening now in China. So after a very long run of rising property prices, it seems like property prices in China are declining, and in some parts very quickly. It's not easy to get very accurate data on this, but a lot of private surveys have shown that from peak to today, property prices in many cities in China have declined significantly, let's say 20%. Now, this has big knock-on effects because property is such an important and widely held asset class in China. Now, culturally speaking, Chinese people really like real estate. It's a big part of what's considered a good asset. Like in the US, people really like the stock market. In Canada, they really like real estate. In China, they really like real estate as well. And so everyone wants to buy real estate, and people who bought real estate over the past few decades did really well. So what's happening is that everyone is exposed to this asset class, and that asset class is declining. So let's think a bit about the linkages of how that reverberates in the Chinese economy. First, of course, let's go directly to the property developers. If you are a property developer, you are in the business of borrowing a whole bunch of money and then building a house or apartment building or something like that, selling it for a higher price, and then taking the proceeds of that sale and repaying your debt. Now, there's a timing difference between this. You borrow money, it takes time to build your real estate project, and it takes time to sell it, and then get the proceeds and repay your debt. Now, property developers, borrowed a whole bunch of money, began real estate projects, and now during the time of their construction, the market shifted, and so now they're not able to sell their real estate or not able to get the prices that they anticipated. So they are in big trouble, and we hear some of the big ones are defaulting. Connected with that, of course, is that if you're building a lot of real estate, you need a lot of commodities. So one of the fallouts from this deflationary event in China is that you can see the stock of major miners in the world have been declining a lot. Now, China is the largest consumer of iron ore and a number of other commodities. If their big construction sector is not building as much as it used to, and there's less demand for commodities, then commodity prices decline, the stocks of these miners fall, and that also, of course, is deflationary for globally as commodity prices fall. It's not the only thing that matters, but it does have an impact. Another linkage would be to look at the local government sector in China. So the way local governments raise money in China is by many ways, but one of the big ways they raise revenue is by taking land that they have and selling it to a property developer. Now, if property developers are going bust, obviously they're not paying a lot of money for land to develop, and then local governments have less revenue. So that means they're going to have to cut back on whatever they were doing, which of course slows economic growth. And of course, more directly, you have a lot of people who bought property with mortgages now, thinking that they would get rich. We've all heard of big apartment buildings in China that are basically vacant, entire cities that are basically vacant, that are basically real estate for the purposes of speculation. People were just holding on to that real estate, thinking that prices would go higher, and so they would become rich. Now those people, they're all stuck with property that is worth less than their mortgage, and that's going to crimp consumer sentiment. Now, basically all these people, they have to continue to pay their mortgages, and they're stuck with an asset that seems to be declining every month. People in that situation are not going to feel positive about their future. They're not going to spend more money, and they're definitely not going to make more investments. So that's something to keep in mind. And the last thing that I would talk about is that financially speaking, this is also going to spread throughout China's financial system, similar to how shadow banking spread agency mortgage losses throughout the US's financial system. So in the US, a lot of the mortgage loans were securitized and then sold throughout the world. And so the losses on the property sector through securitization was able to be felt all the way to banks in Germany and in France. Now, that's not the case in China, but there is something similar. And that is, in China, there's a very large shadow banking sector where things like trusts, products, and private wealth management products are able to spread losses in the property sector to a wide swath of the investing Chinese. So, for example, if you are someone with money in China, maybe you don't want to leave your money in a bank. You could instead buy these investment products offered by these shadow banks that promise a high yield. The shadow banks then, it could be like something like a trust company, take the money and then invest it in a whole bunch of stuff, among which are loans to property developers or real estate related sectors. Now that the real estate sector is in trouble, a lot of these trust companies are not able to repay their retail investors. And so they seem to be defaulting as well. And so that's another mechanism through which property troubles spread to the wider Chinese financial system. So all in all, we see the impacts of this on macroeconomic data. Now, if you look at the growth numbers in China, they've been slowing precipitously. Now, to be clear, part of that is also due to COVID-related lockdowns. Again, China shut down their economy for longer and more stricter than anyone else in the world, and they seem to be having some trouble restarting it. But of course, the property problem plays a role as well. So we've already talked about one linkage where this is affecting the world, and that is through commodity prices. Now let's talk about another more salient part that people have been pointing their finger to, and that is the Chinese RMB. Now, over the past few months, the Chinese RMB has been depreciating significantly against the dollar, breaching 7.2. Now, the way that China manages its currency is that it's a managed peg. So every day, the Chinese government will announce where they want the peg to be, and they allow it to float a little bit with reference to it. So the currency rate is in part determined by the government and in part determined by the market. Now, some people look at what's happening with the peg and suspect that there might be some outflow pressures to that. And there's a good reason why that would be. So if you are the Chinese government and you're sitting back and you're seeing that your economy is slowing, the first thing you do is you want to do something to stimulate it, right? Just like the Fed would cut rates to stimulate growth in the US. And so the People's Bank of China is cutting interest rates to try to stimulate what's happening there in China as well. And if interest rates in China are around 2% and interest rates abroad, say in the US, are above 5%, then obviously that's going to encourage a lot of people to move money out of China and into the US, especially since there's less foreign exchange rate risk because of the managed peg. Now, when everyone is taking their RMB and selling it to buy dollars, that has some outflow pressure. And so understandably, the Chinese RMB would depreciate. But to be clear, that's also part of how China is stimulating their economy as well. When their currency depreciates, their exporters become more profitable. And in theory, that's more positive for their economy. Now, when the Chinese government is trying to defend their currency or manage it, they have to, let's say there's tremendous depreciation pressure against the Chinese RMB. Everyone is selling the currency and trying to buy dollars. Now, in order to maintain their peg, the Chinese government has to be able to take the opposite side of that trade. So they have to take their vast amounts of foreign currency reserves, spend a little bit of dollars, and buy back RMB. And that's how they maintain the peg. They have tremendous amounts of dollars in order to protect the peg. So one other way that this could potentially have some market implications is that as the Chinese currency depreciates, as the Chinese government is trying to maintain the currency from depreciating in a disorderly way, maybe it has to tap into their foreign reserves. Now, foreign reserves are often held in the form of Treasury securities. And so in theory, they could have to sell some Treasury securities to get dollars to support their currency. That could potentially be a higher yield pressure for higher yields. Now, I don't think this is actually going to be very meaningful because if you're a country like China, you have a lot of dollar liquidity held in short-dated treasuries like bills, or maybe in the FX swaps and something like that. So it's probably not going to be selling longer-dated treasuries. In fact, it's very unlikely that's the case. So I don't think it's going to be meaningful, but it is something to think about. Okay. And the last thing that I'll talk about where there could be some kind of financial linkages is many people are talking about the prospect of perhaps a Lehman-like event in China. Now, to be totally clear, I think that is really, really unlikely and fundamentally misunderstands how the Chinese economy works. Now, in the US, we could have a Lehman-like event because at the end of the day, a Lehman-like event basically happens when someone is unable to repay their debts and therefore they have to fire sell their assets. And that happened across many actors during the financial crises. But that's really not going to happen in China because in China, the government basically controls all the actors. One of I think the best China watchers is Leland Miller of China Beige Book, and he makes the same point. In China, the government kind of controls all the banks. So in the case that there is a potential for a Lehman-like moment, what would happen would be the Chinese government would basically force the banks to make loans and keep anyone from defaulting in a disorderly way unless the government wants it to. So, these systemic events are just really unlikely. And then just to further illustrate how the Chinese government is different from many other governments, when you have big sell-offs in China, what does the government do? The government goes around and they tell everyone, hey, you don't sell stock, you understand? So the markets are very managed, and it's like that in many, many ways. The Chinese government has a lot of levers it can pull to prevent any disorderly collapse. So that's really off the table. What's really much more likely is you have slower growth, and the government does incrementally more to stimulate the economy. Many people have been expecting large stimulus packages from the Chinese government. That really hasn't happened. It seems like the Chinese government really is sticking to their pledge to try to transition their country to a less, property-driven or development-driven economy to one that's more potentially consumer-driven. And that transition is going to be, I think, volatile. It's going to mean slower growth, but it doesn't necessarily mean disaster. So far, everyone who's been anticipating large China stimulus has been disappointed. And it looks like it's going to continue that way. So just to summarize, there are some macroeconomic linkages. You can have lower commodity prices, maybe on the margin, higher treasury yields, of course. But there, in my view, it is not any huge downside tail risk here, just slower economic growth. But we'll see as time unfolds. Okay, the next thing that we want to talk about is what's happening in the Treasury market. So the Treasury market, super exciting this past week. We got the 10-year yield soaring to 15-year highs. Now, we've been talking about this for months. Treasury yields, in my perspective, there's no way that they go anything but higher over the next several years. At the end of the day, asset prices are just supply and demand. And what you're seeing in the US government is just unbelievably high supply. Deficit spending that is off the charts. Now, we have an economy that is honestly really strong. GDP continues to grow above trend and it appears to be accelerating. Most recently, the Atlanta GDP Now, which is a GDP nowcast that will be very volatile and be revised, but is at the moment showing GDP growth of 5.8%, which is bonkers. And part of that is because we have significant deficit spending, which even despite strong economic growth, it seems to be about 6-7%. So as that continues, we're going to have a massive amounts of treasury issuance. Supply and demand, who's going to be buying all that and at what price? Now, to be clear, ultimately, it will get bought. It's just that who buys it. In the past, we had the commercial banks buying it because, they were flush with cash and they had nothing else to do, and the government had all these regulations that basically strongly encouraged them to. They've been reducing their treasury holdings. The Fed was buying, of course, they're doing QT. The foreign central banks, they actually haven't really been buying for some time, but they might be selling as countries like Japan and China as well might have to reduce their holdings a bit to get dollars to shore up their currency. So the marginal buyer over the past several months, as I've written about, has really been the asset management community. The asset management community was basically all in on team recession. They were like, oh my God, we have a recession. So what do we do? Well, the Fed's going to cut rates. So we got to buy lots of treasury bonds. We got to buy tech because that's what the world worked, how the world worked the past 10 years. And they were totally wrong. The US economy is doing very well and growth is very strong. And so now they seem to be a bit wrong-footed. What are they going to do now? They're obviously not going to be buying treasury securities at the prices that they were buying before because the world doesn't look as gloomy as it did before. And so I think right now you're having the marginal buyer of treasuries basically having some hesitation as to what price that they're willing to pay for it. And if the US economy continues to surprise to the upside, I think that you can have treasury yields go towards 4.5% by the end of this year. And I think that's going to be very much a headwind for risk assets. Now, we've seen higher treasury yields already put a dent on a lot of the equity markets this past week. But from my perspective, it really hasn't been as bad as I thought it could be. In fact, I think equities are taking it pretty well. And perhaps this is just a brief correction until we resume higher. To be clear, as long as yields go higher, it's going to cap the potential of the equity markets. But it doesn't mean that there's going to be any sort of collapse. Now, if you are a professional investor, you're also going to be looking at treasury yields, not just in nominal terms, but in real terms as well. So you see yields go higher, you want to know if it's real yields or if it's nominal yields. So what's been happening over the past week is that these moves higher have been led by real yields. And if it's led by real yields, then you can think of it as having some bigger implications on the real economy because in real terms, interest rate costs are going higher, and that could mean a bigger slowing of impact on the real economy. So even though the Fed has hiked rates over the past several months, the real rates haven't really changed that much over the past several months. So from my perspective, it really hasn't had a big impact on the real economy. Real rates have basically stayed around here for the past several months, but now they're moving higher. And if they continue to do that, then I think that we could eventually see a material slowing of the US economy. in the future, not this year, but probably sometime next year. And of course, you could see this is a headwind for financial assets and a tailwind for the US dollar. We see some dollar strength a little bit this week. If we have yields continue to march higher, I expect the dollar to continue to strengthen, especially since the data that we're getting from countries like the Eurozone have not been positive. They've been really good in Japan, but the Eurozone is a other major currency pair in the world, and it seems like they're not doing as well. So that's all I've prepared for this week. And if you like what I'm producing, remember to like and subscribe. Welcome to leave a comment as to what you'd like me to talk about. And also, if you're interested in hearing my latest thoughts, please check out my blog at fedguy.com. And if you're interested in learning more about financial markets, check out my online courses at centralbanking101.com. Thanks everyone, and talk to you all next week.